We are living in a time where the cost of living is hitting levels not seen for decades. For those who have the money, it's just a case of weathering out the storm. But for most of us, inflation can be something of a living nightmare. The reason why I bring this up is because the title of this video is 4 places your paycheck needs to go. Appropriately managing your cash and what you do with it is becoming more and more of a necessity. Inflation is one of the main reasons why this is the case. If you find yourself in a position where all of your cash is sitting idle in a bank account, that is not ideal because inflation is eroding its real value. So in order to stop this from happening, you need a plan. A plan which will dictate where your paycheck goes when you receive it. By sticking to this plan, over time you'll start to build a strong base of assets which are resilient against inflation and protect the value of your money. Ideally, you want to automate this plan as much as possible so that the money is sent from your paycheck to its respective locations without you even having to think twice about it. So first up is retirement accounts. Now, some of you will probably be saying, Dan, surely the first place our paycheck needs to be going is towards our bills. Yes, I do agree, but the reason why I have retirement accounts first is to start shifting the mindset towards investing for retirement. Whenever anyone asks me how they can start making the most of their paycheck, I always start with retirement accounts. My thesis on investing in retirement accounts is very simple. You should view your salary as your salary after retirement account investments have been made. In other words, you should see these investments as mandatory deductions from your salary, hence why they're first on the list. By doing so, you're forcing yourself into the practice of actively investing for retirement. And to clarify, when I say retirement accounts, I mean any type of private pension that you can invest in, be it an occupational pension scheme offered by your employer or a personal pension account that you invest in. The reason why investing in retirement accounts is such a good idea is because it's a highly tax efficient form of investing. When we describe anything as being tax efficient, that means you're saving money on tax by choosing to do something. With retirement accounts, you typically save on tax as you invest money into the account, as your money grows within the account, and when you eventually withdraw money from the account. The end result is that you get to keep more of your salary, and the investments you make get the best possible opportunity to grow into very large amounts. But that's not even the best part. Most employers will match what you're investing into your retirement accounts. So if you're investing $200 a month, your employer will also put in $200 a month. This is probably the closest you'll come to free money, and that's why it's so important to maximize these investments as much as possible. Now you might be thinking, surely this is too good to be true. What's the catch? Well, of course, these are retirement accounts, and as the name suggests, you can't access the money you've invested until you reach retirement. But please don't let that put you off from doing this. I recently had a viewer comment saying that they'd much rather, quote, enjoy their 30s, 40s and 50s and spend that money on fancy holidays and big cars as opposed to saving for retirement today. And while I understand the sentiment behind this, it's not the right mindset to have. First of all, being proactive with your retirement savings isn't going to materially impact your standard of living today. Second of all, this mindset really underestimates A, how much it actually costs to fund what could be 20 plus years of retirement, and B, how likely it is that you'll want to maintain your standard of living into retirement. We recently made a video talking about how far behind people are in their retirement savings. The situation is so bad that a significant portion of the population can expect to go from the middle class to borderline poverty upon retirement. Bottom line, there's very good incentives for you to be investing in retirement accounts. It's extremely important and you should be doing it. Once you've made your pension investments, then the question becomes, what do you do with the rest of the money? Now, this is where things start to get tricky because everyone is going to be in a different boat. As I always say, personal finance is personal. Some people are living paycheck to paycheck while others are earning more than they spend. You're going to need at least some cash in the bank for obvious reasons, but deciding how much cash you need is where things get interesting. You've probably heard the textbook rule that you should always have between 3 to 6 months worth of expenses in your bank account. This is commonly referred to as your emergency fund. But like I said, everyone is different and we need to take account of different circumstances, individuals, and tolerances for risk. For example, a student in their 20s is going to have less of a need for lots of cash in the bank as compared to someone in their 30s with a mortgage and kids. Honestly, it's all about figuring out how much cash you need to have in the bank in order to A, pay your bills, and B, get peace peace of mind, while also being aware that the more cash you have sitting there, the more wasted potential there is in terms of investment returns. And by that I mean, if you have cash just sitting in a bank account for no real reason other than the fact that you're not consciously managing your money, you're not only losing value to inflation, but you're also missing out on the opportunity to increase your money's value by investing it. But that's not to say that having excess idle cash is always a bad thing. You equally don't want to be in a position where you have a need for cash but can't access it easily because it's all tied up in investments. This is why cash management is so important. The problem that the majority of the population have is that they don't actively think about their money as a tool, because that's what money is. It's a tool that can allow you to achieve very positive outcomes if used correctly. But most people have a very linear view. Money comes in from doing work and it kind of just sits there until we have a need to spend it. There's nothing proactive about that. Instead of having a plan for our money, we're constantly in this state of reaction. So the bottom line is that you should allocate money from your paycheck to your emergency fund until you hit that magic number which will make you comfortable. Once you're there, it's time to look at ways to make productive use of any excess cash over that amount. Okay, so you've maxed out your retirement account investments and you've put money aside for your emergency fund and other expenses. At this point, we should be looking to take any excess cash in our bank accounts and invest it. That begs the question, what should you be investing in? I'll cut right to it. Index funds need to be the foundation of your investing strategy. The stock market has returned over 10% each year to investors on average since 1957. Index funds allow you to invest in the stock market as a whole, which in turn allows you to access that annual average return of 10%. Instead of investing in individual company stocks directly, you're buying one share in a fund which owns hundreds, if not thousands, of company stocks, indirectly giving you exposure to the returns of said stocks. Why would you want to do this? Index fund investing is low cost, meaning you're minimizing the amount of trading fees and expenses you're paying. It's diversified, meaning your money is spread across lots of different companies operating in different industries, but most importantly, it's convenient. Investing in index funds is as easy as buying one share in an exchange traded fund. You put the money in and walk away. This approach to investing has been tried and tested, and it's been proven that investing in the stock market as a whole over the long run outperforms trying to beat the market by picking individual stocks to invest in. And that includes the professional fund managers who do this for a living. The less time you have to spend thinking about your investments, the better. Index fund investing requires a fraction of the time and effort that individual stock investing requires. As I said at the beginning, you want to automate this process as much as possible. Treat investing like your monthly Netflix subscription. Set up direct debits each month from your bank account to your brokerage account. And with platforms like Book Zero, you can automate investments into index ETFs easily. Link in the description if you want to try it out. We recently made a video covering everything you need to know about ETF investing, and I highly recommend you check that out before pulling the trigger. For the majority, that's probably where you'll stop. If you've maximized your pension investments, you have your emergency funds sorted, and you're investing your excess cash in index funds, then you're in a very good spot. However, for those of you who want to take an extra step, you can start to consider allocating some of your paycheck to other investments. Now, I'm not going to sit here and talk about every single possible investment type there is, because we'd be here forever, but there are some important points to be aware of. The two investment types you'll likely be tempted to explore are individual company stocks and crypto. With company stocks, you need to be doing the necessary research, which involves financial statement analysis, understanding the business model of the company, and making projections for the future. 99% of the population has no interest in doing this, and I don't blame them. Meaning, if you're part of the 99% who isn't willing to do the necessary research, you shouldn't be investing in individual stocks. And if you do invest in stocks without the research, you're gambling, not investing. Yes, there are lots of tools which have simplified this process, but that doesn't exempt you from having to do some degree of work. Does investing in individual stocks have the potential to provide better returns than index fund investing? Of course. But does this investing strategy by nature come with less diversification and higher volatility? Absolutely. That brings us to the key message. Every investment you make must make sense in the context of who you are as an individual. And that encompasses everything from your financial situation to your knowledge and experience to your attitude towards and tolerance for risk. The same principles apply to cryptocurrencies. Cryptos are highly speculative and volatile assets. Most people should probably stay away from them because what most people really want is adequate, not exceptional investment returns. You don't want to be taking excessive amounts of risk with money you can't afford to lose. The bottom line here is that I really do think you need solid internal justification for why you're investing in stocks or crypto as opposed to 100% investing in index funds. And if you have that justification, then by all means go for it. But at least ask yourself the question, why am I doing what I'm doing? So that's 4 places your paycheck needs to go in order. If you want to learn about 7 realistic ways to achieve a net worth of $1 million, check out the video popping up on screen now. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.